mean podcasting machine.
Yeah, you are.
That's right, baby.
That's good.
Let's jump into this, guys. So we've had a volatile week in the markets, right? So if you're using your Robinhood or your Stash or your JP Morgan free investing account, which is a huge thing that's taken over in 2017 and 18, you can invest for free now. No more paying for trades. So in that world, there's no excuse for people to not be investing. I always give this great example of like PGH, plant, grow, harvest. Everyone who works is a farmer. You're making some money somehow, even if it's just $1,000 a month. I don't care what it is. You can throw some of that aside, even if it's just $25, $50, because it is ridiculous the efficiency and effectiveness of the American stock market. The globe envies our stock market. The globe envies our ability to report earnings so accurately and find frauds and things like that. So, putting money in the American stock market, for example, or other developed markets, will snowball into a lot of money as time goes on, as decades go on. That's been the key for me to be able to do more things in my life that I've wanted to do instead of just, being a kind of slave to the corporate world.
Yeah. I mean, interesting, it's interesting perspective, and I agree with most of it, and not to get too, I don't know if we want to get too, heady with it all, but, I don't know that the markets are really efficient. I think you mentioned the financial crisis earlier. I mean, if the markets were really efficient, we wouldn't have had these huge fluctuations on a day-to-day basis, because if it was efficient, all the information would have been absorbed into the prices of all the stocks, and you wouldn't have these huge day-to-day fluctuations. So I don't. So it's not just efficiency. It's also emotion, and fear that play greatly into the stock market, I think. So while I agree with you that generally over the very long term, someone's a very long-term investor that is very smart to be in the market. But unfortunately, I think people have more of a trading mentality. A lot of people have more of a trading mentality, and they think they can find the highs and the lows, and I just don't believe that you can.
Human beings love shortcuts.
Yeah.
And the quickest shortcut is called gambling.
Yeah.
There's no faster shortcut than to gamble. Mm-hmm. If I put all this money on black, and black comes up, I double my money, or I lose it all if it doesn't come up. And they're doing the same thing with the stock market. So it absolutely, on a short-term basis, extremely inefficient, because you've got so many players, so many participants that are just, taking undue risk.
Yeah.
Or not taking enough risk. It could be thought of, it could be shorting the market, or it could be looked at in different ways. However, what I'm advocating is put money in, don't take it out.
Right.
Unless you have a plan to take it out. There's just no need. There's in this economy, this market, this world that we live in today, the way things are set up, in my opinion, use those free trading accounts, put small amounts of money in, and watch it grow. Plant those seeds and let it grow. And when you're ready to say, screw my bartending job, screw my whatever corporate job, you can start to harvest at that point for a year, 2 years, as you let your plane hit the runway and take off on a new career, or travel Asia for 6 months, or whatever you want to do.
It's an asset allocation issue, right? Because now you've got 2 children, so you're obviously not going to be 100% invested in the stock market, or, because you need to make sure that you're not subject to huge, wild fluctuations. If you're also trying to plan for your child's education, and you need to have some cash, but you're a young guy, so you've got plenty of time. But, somebody like me, I'm a little older, so I'm not going to be keeping 100% of everything I have in the stock market, because my time frame isn't as long as your time frame.
Exactly.
I have more cash needs, in a shorter period of time than you'll need cash.
Exactly.
Yeah.
I currently have 50% of my assets in the markets, mostly stock, international and domestic, but also some bonds.
Which you make a distinction between the stock market and bonds. right?
Yeah,
Does the 50% include the bonds?
Yes.
Okay.
All
right.
But they're both markets because like some of the bonds I'll own are like German bonds or like some other international bonds, so they're kind of risky, or emerging market bonds.
Do you own the actual bonds, or are you in a
fund?
Okay.
Yeah,
see,
fund.
I don't like bond funds.
Yeah.
These are too, especially in this environment. With raising interest rates, because the bond funds, they have to hold bonds, right? I mean, that's their reason to be.
Yeah.
So they can't say, well, it's a rising interest rate environment, so bonds are bad investments, so we're not going to invest in bonds. I mean, they have to invest in bonds,
But that same thing's true for stocks.
Well, no, but if we're true, but if we're talking about bonds, I don't know. In this environment, personally, I would just hold the bonds, and just take the rate, and then as they mature, they'll look principal value will eventually get back to the face value, and you'll have at least earned the income. But if you're in bond funds and they're trading and interest are going down, you're going to lose principal.
You prefer to own the actual bond
I'd
itself.
rather own the actual bond.
Yeah,
hold it till it matured.
This is definitely a good point for people listening. It's a tricky concept to explain.
Yeah.
Bond fund versus a bond. So I don't want to get into it too much here. I look at the bond funds I'm in as basically stocks, because a lot of them are higher risk bonds, right? There could be a corporate bond fund. It's not just a government bond. You know what I mean? So there's a whole lot of premium baked into that bond rate. So
every bump in interest rates, the principal value of that bond will go down.
It will impact it. Absolutely. So the bond fund will take a little bit of a hit as a result. But by the way, not much of my portfolio is bonds.
Yeah.
It's mostly stocks.
Well, I actually think your age, because my rule of thumb has always been like the percentage that you be in stock market is 100% less your age.
Yes, I've heard that.
Yeah. So it's like.
So in your case, 45% in stocks.
Yes. Yeah.
Yeah.
And 55% in
For me,
bonds and cash.
That would be 62% in stocks, which is probably not far off for me.
And then the rest in bonds and cash.
For you, the rest
for you,
the rest in bonds and cash.
Yeah, 60%,
so
62%
now,
stocks.
Let me tell you how mine really breaks down. So 50% in stocks, pretty much, are risky assets. I think about it, and then I have 35% in real estate.
Ah, okay.
Yeah, so I own some property.
That's good.
Yeah, and I think of that as kind of a bond, obviously, but the real estate market is different than the bond market.
Very illiquid.
They're very illiquid, but they're tied to each other. So like as rates are rising now, real estate's kind of pulling back a little bit and struggling. So just like bonds. So 50, 35 is where's the other 15?
Cash.
Actually, I don't have a ton of cash.
Purses,
yes.
Listeners, you should know that his wife has a significant.
Wait, hold on. At this point, honey, if you're listening, I need you to just pause and turn off.
Purses, yes.
No, my wife is a wonderful, beautiful woman, and I tell people I believe she has a PhD in beauty.
Yes, she's very pretty. I saw it. Very beautiful.
But also, she can identify something beautiful and choose it for our home or for her own person or whatever, which is a double-edged sword.
Yeah.
Because who doesn't like to see beautiful things and beautiful? I love that.
Who doesn't? Yeah.
But who likes to pay for beautiful things? No one. No, not this guy.
Nope.
Not this guy.
Right.
So my wife.
That's not an earning asset either. Those purses.
You'd be surprised. Depends on which purse.
Purses. Okay.
Oh yeah, some go up in value. Depending, like Chanel, Coco Chanel. Do you guys know about Chanel? This whole.
Yeah.
Right, there's a whole.
She's dead. Is she dead?
She has passed. Yeah, I prefer the word passed.
Okay, passed. Why is it? I don't know why. I mean, he's dead, right? You're dead. She's dead. Yeah, the woman is dead. Yeah.
You sound morbid, man.
All right.
So Chanel, her purses, as well as Hermes, depending on which person, how well you take care of it, they actually rise in value. And my wife, in her geniusness, that's not a word, but cool, I'll make it a word, has like found buyers for some of her stuff at either like right at what she paid years ago, maybe a little below, sometimes a touch above.
Okay.
And
Well, hey.
certain purses, depending on which ones you buy, over longer periods, will really go up. Like the Hermes Birkin's bag and Kelly bag. Don't ask me how I know all this stuff.
Yeah, this is concerning.
You want to know why?
Uh-huh.
I've had to somehow justify writing big checks for purses.
Uh-huh.
And you're wondering why, like, I have no hair back here to the crown of my head.
Oh my.
It was like years of buying those things without doing the research. Now that I do the research, I'm like, okay, this will go up in value, right?
Okay.
And this other voice in me is like, yeah, it's gonna go up in value. This other voice in me is like, you fucking schmuck. You're just buying it because you're scared of your wife leaving you.
Well, there's where your other 6% is, or 10%.
God.